What if everything we think we know about startup success is wrong?
Financials are what's needed to bring more institutional investors. It's also time to add, not replace, the unicorn as a metric.
For decades, we've chased billion-dollar valuations while ignoring the fundamentals that actually matter.
Growth in the innovation economy isn't just about valuation. If you can't over time underpin value with fundamentals, you aren't really going to attract investment at scale.
But what if the smartest investors are playing an entirely different game?
We are here to partner with, founders as early as humanly possible.
It's about conviction built through real relationships, not spreadsheet projections.
Seeing the ups and downs of their evolution gives us conviction to keep following those breakouts.
Yet Europe faces a brutal reality check.
In 2023, at the scale-up stage, our ecosystem was $35 billion light compared to the Bay Area.
But the stakes couldn't be higher.
Those top 100 thoroughbreds alone have generated over 350,000 jobs.
Can Europe's mature ecosystem finally close the $50 billion gap and compete with Silicon Valley? Join us as Saul Klein of LocalGlobe and Yoram Wijngaarde of Dealroom reveal why the future belongs to revenue, not hype.
We're hosting exclusive off-the-record LP AMAs, bringing together the people behind the capital, shaping the next generation of venture funds. If you're raising, planning to raise, or just want the unfiltered truth on how LPs actually make decisions. No pitch decks, no posturing, no script, just real conversations between serious GPs and LPs. Raida Dauk El Jisr, founder and managing partner at Amkan Ventures, is joining us for an unscripted, off-the-record LP AMA on 18th of September. Exclusively for EUVC community members. Through Amkan, Raida backs emerging US-based, sector-focused managers running concentrated portfolios with emphasis on transparency, portfolio discipline, and conviction-led capital. She also leads Amkan Advisory, guiding family offices through bespoke venture strategies, and serves on the board of Endeavor while sitting on selection committees at Raise Global and Bridge Funding Global. Before venture, Raida drove strategic initiatives in sustainable finance, giving her a rare blend of structured planning, impact thinking, and venture agility. This is your chance to ask one of Europe's sharpest LPs how they really assess managers, secondaries, exit strategies, and what most GPs still get wrong, or anything else you're dying to know. Access to these AMAs are limited to EUVC community members. Don't miss your chance to be in the room. Head to eu.vc/subscribe to save your seat.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Early last week, Dealroom released its 2025 Powerlaw report, one that saw LocalGlobe and Phoenix Court ranked #1 investor in EMEA. Saul, thank you so much for joining us today. Congratulations. And first question for you. After 3 decades in tech, what do you think this ranking says about your investment approach?
I've been doing it for a long time. No, I think this ranking is fantastic on a couple of levels. One, I think it shows how strong the ecosystem now is in EMEA, especially by bringing in the idea of colts and thoroughbreds on the revenue side. But I think in general, what it demonstrates is how important it is to be early when you are, assessing value. And that's obviously very fundamental to our approach. So it's a really great recognition.
So Yoram, Saul just mentioned in here colts and thoroughbreds. So let's talk about that. You found that we have now 700 thoroughbreds across EMEA, with your top 100 list representing companies that generate 100 million or more in annual revenue. This is a clear departure from our normal unicorn obsession, and that's of course for better and for worse. Can you talk us a bit about this shift and say why you thought revenue was the primary metric? And then I think we should have a discussion around whether this is smart or not.
Fundamentals, so financials, are what's needed to bring more institutional investors to the asset class. which has become a lot more mature. Like since that unicorn post was written by Eileen Lee, was it more than 10 years ago? The whole ecosystem has matured, and so it's also time to add, not replace the unicorn as a metric. It's not gonna go away for sure, but to add something a bit more robust as well. Also, it has a bit less ambiguity, like either you have 100 million in revenue or you don't. Whereas with unicorn metrics, this can become a bit outdated, and people are not always, they're very proud to say they became a unicorn, but not many people will go out with a press release to say that they're not anymore. I think this 1 billion valuation still has a lot of value and is more forward-looking. Sometimes it's in some cases it is more relevant. So the combination of the two work really well.
Saul, you've been in the game for 30 years, as we just said. Can you walk us a bit through the unicorn fascination that we've had, now our shift to focusing more on revenue metrics? What has happened inside LocalGlobe? Has it really been something that has shifted, or have you always kind of viewed it as at a fundamental level and then said, well, the media is unicorn infatuated, that's what the game we play, but in reality, inside the firm, we've always been focused on the metrics?
As you said, I've been doing this now for over 30 years, and I kind of learned my trade, if you like, in the Bay Area, in the US, in the 90s, and then, learned through my time at Skype, and then at Index. Growth in the innovation economy isn't just about valuation. It has to be a combination of the hope and promise that I think the unicorn term captured really, really well, but also the fundamentals. And I mean, just even to roll the clock back to Skype, 2003, 2004, I remember us going from 0 to 5 million and from 5 million to 200 million in a 12-month period. And, revenue is a much less subjective measure, obviously, than valuation. Valuation is just the consensus between individual investors agreeing on a market price. And it's really important. But if you can't over time underpin value with fundamentals, you aren't really going to attract investment at scale. And I think back to Yoram's point, while 20 years ago, we were operating in an ecosystem where companies like Skype, that had reached 100 million in revenue were kind of, once every few years. The fact that we now have 700 plus companies doing over 100 million in revenue that were venture backed, tells me that we are, a really grown up ecosystem, and that any investor, from an insurance company to a pension fund to an endowment, can look at the products of venture capital allocation and say, wow, these are real companies generating real growth. And, we have ways of pitting our valuations against the fundamentals. Now, that should never put us in a situation where it is just about the revenue or it's just about the margin. But, those things end up being incredibly important. And I think, no investor would say that at the end of the day, companies get measured by fundamental financial metrics, including free cash flows. So I think, demonstrating that, in a 20-year period, because arguably, we've only really been at it in EMEA for 20, 25 years, whereas in the Valley, it's been 50 years in the making. To have 700 companies that have hit this threshold, I think, is an incredible achievement, and that's the thing we should be really happy about.
Speaking of growing up, Saul, I'd love to ask you a bit about the LocalGlobe or Phoenix Court journey. LocalGlobe is obviously early stage and seed, but then you've added in also the fund investing side, and you've added in solar for growth. So Latitude for fund investment, solar for growth. I'd love to talk to us a little bit about this perspective or the importance of having multi-stage firms and firms that can really do more than just the seed, so to say?
Look, I think for me, this is, again, it's just as the product of starting with the premise that we are here to partner with, founders as early as humanly possible. So pre-seed and seed, which is what LocalGlobe focuses on. And the founders that we're looking for are the founders who, in Andy Radcliffe language, are the founders who can ride multi-decade waves. And again, my observation, having been around for 30 years, is that the biggest waves don't just last for 5 years or 10 years, they last for decades. I mean, to put it in perspective, as an industry, we're still investing in semiconductors, and that wave started in the early 70s. We're still investing in the internet. That wave started in the mid 90s. We're still investing in mobile and cloud. That wave started in the 2008. So, if you are lucky enough to work with an exceptional founder who you meet at seed stage, or what we call, if you want to meet a great surfer, you live on the beach. If you want to follow them all the way up into the hills and all the way to the city. Companies, don't become bad companies as they grow. Arguably, they keep on getting bigger. And the Powerlaw teaches you that not just in the private markets, but all the way into the public markets, these outliers are the ones that generate the best returns. So really all we've done with LocalGlobe and then with Latitude, that invested early growth, rounds of 15 to 100 million, typically Bs and Cs. And then we piloted about 3 years ago, our solar fund, which is sort of investing in the scale-up rounds of 100 million plus. It's just keep on following those founders that, we see going from the beach to the hills to the city. And we now have in our portfolio, I think, 54 companies that are doing over 25 million in revenue, 70% of which we invested in at seed stage. So we've been really privileged by focusing at that seed stage to see these companies grow up. And some of these companies, whether it's Wise or Melio, we're investing in all the way through. I mean, while obviously we were lucky to invest in Wise through LocalGlobe at the seed stage, we reinvested through Latitude, and we invested through Solar in their direct listing. And we've been shareholders in Wise for 5 years since they've been in the public markets, because, in our view, this is still a company that has a lot of upside.
So it's often said that VC is an access class, right? So I guess from that perspective, it makes a lot of sense to leverage that access to double down on winners. Is that a fair way to think about it?
Yeah, 100%. And, one of my partners, Julian, talked about access, insight, and engagement, or, having seen the movie before. So, someone is investing at early growth stage or scale up stage, very few of those firms will have seen, the ups and downs of those businesses. And, in our view, numbers only tell you so much, but really, working with the founders, working with their teams, seeing the ups and downs of their evolution gives us, a lot of conviction to keep following those breakouts, founders and those breakout firms. And as I said, having been around for a long time, I've seen that even in the public markets, you can get extraordinary returns. I mean, I was lucky enough to compete with Netflix when I was running LoveFill. And, just to track the Netflix stock, I bought, $1 of Netflix, let's say in 2002, 2003. I've sat on that $1 of Netflix for 23 years. That dollar is now worth $1,250. If you'd invested in Amazon in 2002, they would have been public for 5 years. Your dollar in Amazon in 2002 would be $20,000 today. Yeah. So if you're lucky enough to be in an outlier, our view is that you should just keep going.
Could you talk to me a bit about how we solve the growth stage, because you're obviously doing it from within the Phoenix Court world. I'd love to ask you, what are you seeing in the ecosystem, Saul, that are working and that we should be doubling down on, and what are you maybe a bit more hesitant around?
Well, look, I think as Yoram said at the beginning, one of the biggest challenges that we have in the UK, in Europe, in EMEA, is that, we've become actually world-class at creating great early stage companies. These companies, this cohort, 700 that have reached the 100 million revenue mark. However, if I just look at the UK or the 5-hour train ride from King's Cross that we call New Palo Alto, in 2023, at the scale-up stage, these rounds of 100 million plus, our ecosystem was $35 billion light compared to the Bay Area, not the US, just the Bay Area. And I think, Yoram, correct me if I'm wrong, I think that number got worse in 2024. And, the gap at the scale-up stage went from 35 billion to 50 billion. And it doesn't take a genius to understand that if companies hit a certain scale and a certain stage, they need capital to keep growing and to keep expanding. And, if the companies in our ecosystem at that stage, just compared to the Bay Area, are getting $50 billion less per year, obviously they're going to get their terminal value, their exit values, their enterprise values are going to end up, being smaller. So, I've felt for quite a while now that until we bring in capital at scale at that stage, we aren't really going to sort of fulfill the potential that we've now, I think, evidenced and demonstrated through these data sets. Now, to be fair to large pools of capital, domestic, regional insurance companies, pension funds, the evidence just really hasn't been there. 5 years ago, 10 years ago, 15 years ago, you couldn't have said, oh, look, here are 700 companies doing 100 million in revenue that didn't exist 15 years ago. That would just be nonsense. But today, I think we have the evidence. And now, it's just really important, I would say, for sort of European economic growth and developments, that we pay attention to these thoroughbreds, that we pay attention to these colts, that we pay attention to these unicorns, because this is where the jobs are being created. I think those top 100 thoroughbreds alone, have generated over 350,000 jobs in 2024. So, this is not just about science projects. This is about jobs, it's about growth, and it's about economic development. And I think we could all agree that's something every country in Europe, really needs right now.
No, the only thing to add is that not only is there this 35 to 50 billion gap, but to the extent that European or EMEA scale-ups do get funded, also like 80% is coming from overseas. So even the money that they are raising is barely coming is barely local.
I'd love to ask you something, because yes, we can always get new growth funds, and there are strong people working on that, obviously, with capital coming from KfW and EIF being directed towards that. There's maybe one place where I think that we can do a real difference in this podcast today, which is talk a bit about how do you take a firm that is traditionally seed stage and pre-seed and grow it to become a real franchise that can act across the value chain. What would you say to those that are out there now, have proven themselves in seed and pre-seed, the firm is growing, and they feel like now's our time, we should actually go for the multi-stage approach? What would you say are the core learnings, the core things to be mindful of?
I think our learning, as I said, is just to sort of follow the founders. Every new vehicle that we've created, Latitude, and then Solar, has really been a response to wanting to stay in the game and to support the founders. bigger those cohorts have become, the clearer it was to us that, in the early days, let's say before we institutionalized Latitude as a fund, we would create a number of SPVs to continue to invest in our most promising companies. And I know, a lot of people do that and have done that in the last 5 to 10 years. But, when you start to see, at least in our case, there are 54 companies that have hit a $25 million threshold. It makes no sense not to have institutional vehicles, both at the early growth stage and then at the scale-up stage, to participate. And even, quite frankly, if it's to help your LPs generate co-invest opportunities. So for us, actually, Latitude doesn't lead rounds. Solar doesn't lead rounds. And actually, our fund sizes at the Latitude stage and at the Solar stage are relatively modest for funds of those sizes. And we do that because for us, those funds are there really to concentrate capital on companies that we've invested in primarily from seed stage and to facilitate LP co-invest. So my advice would just be to follow your customer, and your customer is the founder. And if your founders keep growing, assuming you are a good partner to your founders, and most seed funds really are, because they've been there at the beginning when nothing it exists, and you can continue to follow, and I think it's actually quite important, particularly for LPs that are newer to the asset class, to have managers that are close to the companies that can help them really sort of understand what's going on. So, to me, this access and engagement is a real positive. Now, obviously, you have to be careful that you don't fall in love with all of the investments that you make. But I think, at least in our case, this is where, not leading at Latitude and not leading at Solar has been a really, really good discipline, because, we're making a capital allocation decision that's really very different from a traditional multi-stage fund, I would say.
Have you ever felt that the inability / the requirement that you are not allowed to lead, have you ever felt that kept you from being able to do an internal round entirely alone that would put you in a better spot going forward?
Not really. I mean, occasionally we will, work with a company to write a note to the next rounds, which again, for me, is really about supporting founders or teams to kind of build more value into future financing. But, generally, it's, for our perspective, it's kind of maximizing alignment with the founders around not pricing, but also, being clear to our LPs that we are not going to be setting the prices at the Latitude stage for companies that have come out of the LocalGlobe pipeline. And I think, that clarity has really helped everyone.
We're on a tight schedule here, so we only have 4 minutes left, and I want to make it to just touch on one critique that there's been by some around the report or the methodology, which is, of course, that there's 100 points given to seed stage investments and only 30 to Series A, which then, of course, kind of skews, you could argue, in the final point system, the report or the findings, the awarding of the winner, so to say, towards the seed stage.
I think you also earlier asked the question, like, shouldn't we emphasize more growth states, especially because that's where the gap is? Yes, there are a lot of seed investors in Europe, but research also shows there's a massive difference in quality. And for example, if you raise from the right seed investor, you have a 4 times higher expectancy to convert to Series A and to raise from the best late stage funds. So I think maybe we have a high quantity of seed investors, but I think we need a much better picture of the quality. And overall of the weighting, it's based on the kind of median valuation uptick between rounds. what you also see is that if you look at kind of the likelihood of investing at seed stage to a company that becomes either a thoroughbred or a unicorn, it's way and way lower. About half of growth stage investors invest in a unicorn. Also, about half invest in one that reaches thoroughbred status, but only 1 in 10 seed investors invest in one unicorn. Where it becomes really even more interesting is the ones that invest in 10 or more unicorns. That's 1 in 1,200 firms that invest at seed stage in 10 plus unicorns. So that's where you really want to know where the outliers are. And so that's what's been kind of the thinking behind the methodology. And you can see also SoftBank, Tiger, Insight. So there are some later stage investors that are also in there.
Could you tell me a bit about the difference between picking at seed versus picking at the later stages?
Look, I mean, the most obvious answer to that question is just, the amounts that you have to go on at seed stage is really, the people and the people's view on the market and what the people say they're going to build for that market. And, sometimes there's a little bit more evidence, sometimes there's a little bit less evidence, but you're really, really, again, I love the Andy Radcliffe framing, you're backing the surfer and you're backing the fact that this is a sort of a multi-decade wave. Obviously, as the stages go on, and personally, I don't really like seed A, B, C, etc., because I think, people name these things all sorts of crazy things. You can have 60 million seeds and 150 million A's. And actually, what I love about the Dealroom methodology is it sort of frames the stages on the amounts of capital raised. And I think that's a much better way of sort of looking at early and breakout and scale. But I think, in our view, even when companies get to the point where they have lots of data that you can look at and you can do customer calls and look at cohorts and all sorts of metrics, from our point of view, I'd say at least 50% of what we're looking at, even at that stage, are the founders, the team that the founders have built, and how they operate. Because, if you look again at the companies that have gone on to compound year after year, long into the public markets, it comes down to just like exceptional founders, incredible leadership, and their ability to build great teams that sort of whatever is happening, they can find their way through or kind of pick themselves back up. And that's why, to me, the sort of the DNA of seed investing or, is very consistent across stages. So, to me, early is a mindset. It's not a stage. But you hone that mindset at the seed stage is my belief. And, again, in 20, 30 years, I've seen a lot of the Series A funds or even the Series B funds or even the early growth equity funds come down to the beach. Like the beach is a pretty cool place to be when the weather's nice. But you've got to be crazy to live on the beach 24/7, 365. And I think, that's what seed investors do. They live on the beach. And, they don't have a bungalow overlooking the beach, like a Series A fund. They live on the beach. And I think, you've got to look at people who have gone through cycles and remained there. And it's very, very few. And I think, obviously, I'm talking at our own book here, but to me, we're starting to see a body of evidence now with these rankings where you really see the value of living on the beach. 0.9, Seedcamp, YC, and others. These are all firms that are sort of really shining in these rankings. And, the other thing is that, even whether you look at the EMEA rankings or the global rankings, it's the companies, the firms that are sort of right at the beginning, that are the ones that are really, I think, building these cohorts of value.
Saul, Yoram, thank you so much for joining me today. Saul, I want to give a big shout out to you. First and foremost, of course, congratulations with topping out the ranking, but also thank you so much for continuing to contribute so much to the European ecosystem. It is incredibly valuable. It's one thing what you do in the ecosystem with the founders, but also coming on the podcast today, talking about how you've built LocalGlobe and Phoenix Court into what you are today, talking a bit about the importance of growing with your founders and staying with them and finding ways to do that as a firm, I think is incredibly important for our VC ecosystem to really pick up on and learn from.
Thanks so much. Have a good week, everyone.
We're hosting exclusive off-the-record LP AMAs, bringing together the people behind the capital, shaping the next generation of venture funds. If you're raising, planning to raise, or just want the unfiltered truth on how LPs actually make decisions. No pitch decks, no posturing, no script, just real conversations between serious GPs and LPs. Raida Dauk El Jisr, founder and managing partner at Amcan Ventures, is joining us for an unscripted, off-the-record LP AMA on 18th of September. Exclusively for EUVC community members. Through Amcan, Raida backs emerging US-based, sector-focused managers running concentrated portfolios with emphasis on transparency, portfolio discipline, and conviction-led capital. She also leads Amcan Advisory, guiding family offices through bespoke venture strategies, and serves on the board of Endeavor while sitting on selection committees at Raise Global and Bridge Funding Global. Before venture, Raida drove strategic initiatives in sustainable finance, giving her a rare blend of structured planning, impact thinking, and venture agility. This is your chance to ask one of Europe's sharpest LPs how they really assess managers, secondaries, exit strategies, and what most GPs still get wrong, or anything else you're dying to know. Access to these AMAs are limited to EUVC community members. Don't miss your chance to be in the room. Head to eu.vc/subscribe to save your seat.
This was their finest hour.
Tear down this wall. It's more than just an alliance. This is a union of values.
Let's start acting.